Ladies and gentlemen of the crypto space, we're live on a Wednesday, May 31st at 1:02 p.m. We're back with the Wednesdays. Let's see how well the bandwidth keeps up today. I got some complexity in the local system. We'll do the best we can. Arnold's up on the screen. If it bleeds, we can kill it. Come on, that's Prince the Fed will like it. And that is an interesting topic that we discuss a lot, is what I just tweeted with a different meme, and it was more of a Powell-centric meme. But I think the causality of what liability printing in the crypto markets would do to the capacity for buy pressure at Treasury auction is quite obvious. And obviously, it's marginal compared to the amount they may need to ultimately print on an upcoming or continuous basis. But come on, and even marginal, everything starts at the margins, change starts at the margins, and it makes sense. Let's pop it over to the main screen and I'll talk about what I mean. If I could find the main screen button. Oh, well, up as a US M2, and we don't see any significant, well, actually global M2, but we don't see any significant contraction there. So what this tells me is we're in for short-term volatility, and Treasury issuance can easily pull from domestic liquidity. Specifically here is where we'll see a domestic liquidity drain. If this remains high, optimally we'll see a reduction in this value that's somewhere comparable to Treasury issuance, and that would indicate the capital is coming from the reverse repo and not necessarily from circulating liquidity. This is a drain on domestic liquidity conditions, the reverse repo market, and they need to raise capital. So that means that capital's got to come out of a system. Optimally, it would come out of this system, in which case there'd be a net no change in domestic liquidity conditions. Balance sheet is still relatively high, and this chart will obviously be affected by whatever happens next month when Treasury finally kicks into gear to refill the TGA. And look, the bottom line is to refill the TGA, they got to throw a bunch of treasuries to auction. And that is the title of the stream. I find it fascinating that if the crypto markets are using native collateral, which is equivalent to another sovereign nation issuing bonds, same thing we do, obviously they do, and they raise capital, and those bonds are used to collateralize dollar-denominated debt positions in a CDP, a euro-dollar account, and this is where the global dollar-denominated debt comes from. That same phenomena exists in crypto markets, except this is a global market spanning all countries with no permission, using a deflationary collateral, Ethereum, with all the LSDs that are starting to circulate, and and all the derivatives of Curve, and all the improvements to Curve, and the capacity to print dollar liabilities using Curve's liability system. Oh my God! It's like once you see the connection between these crypto liabilities and the sovereign debt market, U.S. in this instance, it's just fascinating. What happens is, let's say there's $10 billion of Ethereum used to collateralize uh, CRV USD. That goes into LP positions, and those LP positions will impact overall pressures on Curve and Tether. So as Curve and Tether are forced to manage their peg, they are likely going to have to increase their capitalization, their balance sheet composition, and that if they need more sovereign collateral, sovereign debt on their books, they're going to have to buy it. And they either buy it from the open market or they could buy it from issuance. So it's either off the rung or straight out of auction. And if it's a large enough number, if they need to come up with 10 bill and they can't get that in the open market, all of a sudden you see Circle and Tether at auction. Listen, if someone's coming to Treasury auction and they got a 10 bill clip they need filled, pretty sure Treasury's going to be like, all right, come sit at the table. So that's the connection right there. And there is that quantity of billions of dollars in collateral available to borrow against in crypto markets now, not even in future market cycles, not even with increasing liquidity conditions in the real financial system, literally just with liquidity conditions in the crypto markets in this insanely contracting liquidity landscape. I mean, listen, WBTC. You could get 50, you could get 100 bill, and you'd be like, all right, there's some serious liability printing. You know, you collateralize and you print 75 billion off 100 bill worth of collateral. Let's say most of the market actors are sane for some reason, and they print 50 bill. 50 bill obviously would require a 50% capital loss on the principal used to collateralize those liabilities. But that's relatively safe. I mean, if you look at like MakerDAO and their thresholds, or Aave and their health factor, 2 to 1 health factor on Aave, it's relatively safe for most people's standards. A lot of people do much more degenerate. I'm sure the vast majority would be less than 2 to 1 health factor from an Aave perspective. And if you have 100 bill and you print 50 bill, that's going to totally distort Circle and Tether's pegs, which will have an impact on their balance sheet composition requirements, which will have an impact on either off the wrong treasuries or stuff coming to auction. And that's pretty interesting. That's interesting. Yeah, but nothing's going to change in the short term with regard to volatility of price action. I can't believe the DXY is getting up to 105. But, I mean, even this move is relatively marginal. You can see a blowout to 109, and that's still a ridiculous double top. So this will take months to play out. This is the 6-month chart. Basically, we don't have a capacity to assess where we are until the end of the year, September, October, November, December, Q4. That's my probably min time frame to really assess where we're heading into 2024. You need some months. You need to get through summer. What the hell is going to play out with commercial real estate? I mean, the banks and the inverted yield curves, they have no business. How does that work? Borrow short, lend long. Come on. This is going to be insanely volatile in the short term. So that doesn't mean much with regard to interesting technology. That means something with regard to capital allocation, position sizing in the short term. It has no impact on identifying the final destination of capital to adjust portfolio composition, but doesn't affect the inevitable composition itself, the sizing and proportionality of the composition, sure. Some interesting new things. Where was that? I constantly look at Pulse on Deck Screener to see what kind of a disaster is going on, and it is a catastrophe. People are getting slaughtered. All these poor left curvers getting absolutely decimated. The numbers are outstanding. Anyway, it's pretty miserable to look at that. Oh, did it change the location? It changed the location of where I was in my feed. Oh no. Okay, so Curve launched their Try Crypto Next Generation, which is meaningful. It's a significant reduction in complexity, which is an increase in efficiency, which is a decrease in gas cost for interacting with the contracts. I'm quite excited about one, obviously an efficiency improvement, but the composition of Try Crypto pools. Uh, the original Try Crypto, WBTC, ETH, USDT, I think is literally just the tip of the iceberg. I look forward to the LSDs being part of that composition, as well as not USDT, but USDT also amongst the other very interesting stablecoins. How about stablecoins CRVUSD, as well as this new stuff that's coming out? They're going to be just derivatives of like an LUSD or a derivative of a CRVUSD. This has gotten some attention lately. Lately, literally just came to social media. So recently, this looks interesting, and it's basically just all the LSDs. So, liquid staking derivatives are very interesting for a collateral for a debt position. Um, it has overtones, rings overtones of traditional financial constructs, an interest-bearing asset that you're borrowing against. What's the borrow rate? If the borrow rate is less than the interest on the collateral, you are in an interesting position with regard to your debt obligations, your debt servicing costs, as well as just your collateral composition, because the principal valuation is increasing over time. Obviously, volatile dollar denominated, but increasing in uh, in the value. The quantity of the principal component. You're getting more Ethereum over time. So it's interesting what could come with regard to derivatives in the future. Um, like if you borrow Ethereum against an LSD, uh, that's like a risk-free rate of return. You owe Ethereum, but you're getting interest on your principal denominated in Ethereum. So you got to always remember, like dollar denominated is what introduces the complexity in collateral management for debt positions, because it's dollar denominated and you're posting something other than a dollar asset. You're posting a volatile asset dollar denominated, so the number changes, the value changes. But if you restructure your debt taking process to be entirely denominated in something other than the dollar, then the equation changes. So if you're borrowing Ethereum from a liquid staking derivative that's producing 3, 4, 5, 6, 7, 8%, that's a different equation. So it's quite interesting. It's the risk-free asset Ethereum denominated. Next couple of years are going to be quite interesting because if that's the risk-free rate of return, Ethereum denominated, then you're able to measure how much risk other positions are because there's the relativity factor. And now you have a curve. You have a risk curve. We don't really have duration in these markets, but we definitely have a risk curve, and now we have an increasing capacity to measure it. So it's very interesting. Tapsy's in the house. New rank, Captain Meme Lord. I mean, these are quality memes. This software is crazy. Definitely a lot of fun. Yeah. Good morning. Good morning. I have some questions. Happy to help the best I can. Ding ding. Happy Wednesday, Dan. Nice Wednesdays are back. The best I can. I'm happy my bandwidth is keeping up today. Loki. Happy Wednesday. Raul. Heath. Hey Cap. How would you rate Lit Bunny revenue generation up to now? Yeah, the revenue's very interesting. I'm quite satisfied with it. Obviously, this market is depreciative, liquidity is draining. So, from a position standpoint, I just would have liked to have it cheaper, have had it cheaper. But the numbers are quite nice. There's 10,000 plus in bribes, plus transaction fees, and a lot of capital being thrown at VE Lit. And that's meaningful. That means it's productive. So, maybe marketing to attract more of the liquidity from Uniswap over to Bunny, but ultimately that liquidity goes directly back to Uniswap. So it's a tough market because of the composition of Uniswap's user base. They're just full on left curve. They don't know about aggregators. They don't know about DeFi. They don't know about anything. They literally just know Uniswap and MetaMask, and anything else is like, what the fuck is going on? So it's complicated in that regard. So I don't have the clearest picture of where things are heading. But overall, I'm quite satisfied with the productivity of the position. I wish I had it cheaper, but am I surprised that it is now cheaper, considering the directionality of markets, the liquidity composition, and draining reality of markets? No, I'm not surprised. Food for thought. It's hard. It's hard. You're never going to find bottom. You want to get the cheapest discount you can on cash flow productive assets and enterprise. And, you don't have distress in crypto markets the same way you do in traditional finance. It's not like you have bankruptcy or hostile takeovers. You just have a 24/7 liquid market. So everything's priced in real time. It's not like you could buffet the shit out of these. They're not companies. There's just protocols that are just constantly cycling and capital is churning. It's quite different. So when is bottom? Well, I don't know. You want it cheaper. And frankly, you can always be cheaper. And that's not necessarily fun thinking from an entry price perspective. You can always get cheaper. Everything can keep going down. And you'll see it in DeFi Llama when things start going up. You'll see the liquidity composition, the liquidity flow. Arbitrum got a little bump, but it's only at $1.87 billion. Ethereum's minus 0.5% on the 7-day, sitting just below $70 billion. It's been hovering at around 70 bill for quite some time. Let's go over to all and see the line graph. So Tether obviously significantly outperforming USDC with regard to capital inflow. This is quite interesting. Just compared to 2019 and the amount of the market cap. When you talk about market cap of stables, you're talking about basically the collateralization of them. These are liabilities based on the collateral valuation. So this is quite interesting. This is extraordinary for 3 years' time. And I very much look forward to seeing what it's like in 2020, Q2 2024. Q4, Q1 2025. It's going to be very interesting. This is such a wonderful page for perspective and to really ground yourself on what's going on in markets. Folks like Left Curve will just literally just ape into absolute shit, as we've seen with people sending money to actual Ethereum addresses, just naked sending money. What kind of insanity is that? Who does that with money? That's not even gambling. That's just giving someone money. That's crazy. So that's where we are with a negative sum game. The liquidity is draining from the markets. There's no real opportunity. So a person that doesn't exercise due diligence has an incapacity to differentiate between actual opportunity and just either fraud, scams, or gambling. Because when you have a positive sum environment, you're going to actually see capital allocation to the things that are outperforming. The real assets, the real enterprise, stuff that is systemically meaningful. Infrastructure will receive the capital inflow. And that's what's going to be inevitably in a year, 2 years. When the capital flows in, where is it going to flow? It flows to the base layer. It flows to the infrastructure. It flows to the least risk first. And then it goes out on the risk curve after time, after complacency sets in, after people are like, all right, I came in, I brought the capital in, I'm not taking much risk. Take 5%, 10%, start taking risk. And that's how the entire risk insanity of the crypto cycles plays out. It all starts with the relatively least risk allocations, which is very interesting heading into upcoming liquidity cycles whenever they come, because now there's a composition of assets that are available that were never available. At the end of 2019, you were talking about just Bitcoin, Ethereum, and I have no idea how people assess the relative risk profile of competition in late Q4 2019. But now there's incredible mainnet DeFi protocols that are quite tantalizing from an infrastructure perspective. What is infrastructure? Particularly protocols that are being consumed as other protocols. Other protocols launch, they try and capitalize on the lendiness the history, the brand name of a base layer infrastructure implementation, and that just further entrenches the base layer infrastructure as more and more things build on it. It's going to be crazy when we start to see plus 5, plus 10%, and we start to see Ethereum get back up to 100 bill, 200 bill, 300 bill of circulating liquidity. It's going to be fun and exciting, and we've been talking about it for years. We know it's going to play out. So it's just about patience and getting the cheapest price possible on infrastructure. Shit that other people and protocols are going to build on. That's the deal. Dan, Ethereum BTC charts look Ethereum BTC chart looks quite interesting, and I have had that up. I actually coincidentally pulled that up yesterday. This is a chart of Ethereum versus BTC log, obviously. Raul is well known to like this chart, and for obvious reasons. This is a monumental symmetric triangle. It's not even funny at this point how structurally large it is. Somewhat of a left-leaning inverse head and shoulder. I don't know, but this looks remarkable. Where does the capital flow in? I think this is where it flows in. I think Ethereum outperforms significantly. A global emerging market with permissionless access from any country. What is it called? The traditional finance is called correspondent banking. The historic way of moving capital around the planet was banks, intrabank relationships that daisy chained the planet. And that's because if you're in Korea, you got to go through India to go through Europe to get to the United States to finally get to a destination in South America. And this is a market, a layer above everything. And it's a banking layer because you're able to transfer capital. You're able to have assets that retain value. Volatile, but there's value. So it's quite extraordinary. You could permissionlessly access this market from anywhere on the planet directly without any correspondent requirements as per traditional banking infrastructure. And that changes the whole equation. It tells us the destination of where market interest will be in the coming decade. Between now and the coming decade is significant in regards, but it's obviously irrelevant in many other regards. It's fascinating to contemplate the destination. It's really the issue that a lot of folks dealing with markets have is they focus so much on the destination, Bitcoin to $1 million, and they get absolutely destroyed in the volatility and cycles in between. And that's it's important to try and put a framework to that reality. And that's why we've latched on significantly to enterprise as a sustainable framework to engage with both the short, mid, and long term simultaneously. You ain't doing shit with a $1 million Bitcoin other than selling it. And then you don't have it, which is why Bitcoin is only currency inflation protective. It's not consumer price inflation protective. Enterprise is the only thing that protects against both. Because the valuation of the enterprise will increase as the currency is debased, as Raul talks about, and as, consumption, Metcalfe's law plays out with these enterprises, and the user base significantly increases, and liabilities are printed left and right. And to top it all off, they're paying you on a weekly basis cash flow, so you don't have to sell the enterprise. That's why it has such a significant effect on a person's capacity to withstand the short-term volatility. Because you don't have to think about, what's my enterprise valuation going to be in 2028, 2030? Everyone's like, well, Bitcoin's $1 million in 2030 and Curve is $50 in 2030. You don't have to sell your Curve in 2030. It's paying you cash every week. Changes the equation looking at things like that. How are you going to get to 2030 if you're not making cash in between now and then? Enterprise is far superior to savings. Maybe enterprise is the better savings. It's superior to savings. It's productive. It's like owning a business. Anyway, I don't need to rant about it too much. We've only been talking about this damn topic for how many years at this point? Yeah, I like this chart, Dan. Yeah, where do you look for Curve's revenue? Curious to see its growth over time. So there's multiple sources of revenue. You're not going to get the full picture, but if you go over to Classic, you want to go to the Classic. So you go over here, and then when this loads, there's usually the Classic button up top, but it's not loading. I probably have no bandwidth at this point. I got this. I got this, boys. Classic. Use Curve, and you can see the transaction fee revenue. So $116 million since launch. And, you know, it's down significantly. It was $105,000 last week. Up 5x for the week, which is nice. It'd be nice to get a couple $100 instead of 100. You know, so it's nice. It's 1, 2, 3, 4, 5% give or take. But the big money comes from the vote rentals, which are significantly higher. You know, you get about 20 to 40% give or take any given week, depending on the amount of votes that you have to be rented. So there's no real history for that, but it's just been solid for all of 2022 was solid. And it's just what it is. You know, most folks are not walking around with a million CRV. If you're walking around with 50,000 CRV, you get in 600, 100,000 CRV, and you get in $623 for the week, $600 for the week, $590 a week. You know, I like to think in those terms and how I look at this, and you got to be careful with the amount of total capital that's available for the weekly. Again, 20, 30, 40% of your money. And that's interesting, especially if you got like 10,000 Curve, you're clearly going to be able to capitalize at this higher number, 39%. Now the problem is all the stupid meme coins and people trying to turn $100 into $10 million. It's insanity, which makes 40% off the table to all those people, that entire left curve community. 40% is a number that is jaw-dropping extraordinary. It's just unheard of in traditional finance. And it's real in the crypto markets, especially for the smaller actor. The problem is 40% needs to be taken into consideration. It's not going to get someone to maybe, you know, the exuberance they're looking for, the adrenaline rush is, but it saves and it compounds and it grows, and this is real. If I was 22, if I was 20, if I was 18, and I had 20 years to do something at 40%, 20%, 20 to 40%, it changes everything, changes the whole equation. And that's withstanding the principal appreciation over the coming decade. These numbers are absolutely astronomical. And these are the things that the degenerates ignore. Insanity. Lucian in the house, a pleasure. Also, what do you expect total market cap of stablecoins to be in 5, 10 years? There you go. Now, that's the damn question. I love that question. Come on, we're at 129 billion dollars. Now, bear in mind, stablecoins are two forms of composition. You have capital inflow, such as Tether, that people take government debt and they collateralize Tether to print their liability. So it's like a capital inflow of sorts. You also have domestic liability printing, Ethereum printing liabilities, collateralizing liabilities. And that's like a capital expansion. It's a money printing. It's the same thing with using government securities, but it's kind of like capital coming in from outside or capital being created from within. It's the type of mental imagery that I have. 129 bill right now. Do I really give a shit about the other chains? Not really. Ethereum mainnet 70 bill. Come on, how are we not going to be at like 1, 2, 3, 4, $5 trillion in liquidity? That's not valuations. How are you not going to have a 10x in the amount of capital inflow? And that's not chasing trading. That's not chasing derivatives and protocols, GMX and whatever, what synthetics. Albeit that's where a lot of probably brokerage capital and hedge fund capital will be destined. But we're talking about assets that facilitate liability printing, credit. That's extraordinary. You know, if you're a small business and you have to go to a bank and go through underwriting to get your net 30, net 90 to do your financing, so you actually have capital on the books to deal with the time it takes for accounts receivables to come in. You might not have that kind of access that you historically had in traditional finance, traditional banks, but these systems are permissionless. And yes, you need collateral to be able to acquire the liquidity, to borrow the liquidity. But now you're talking about balance sheet composition. Not every business is week to week. Not every business is dead broke. So now you have a capacity to change the composition of your enterprise balance sheet such that you could leverage it for financing permissionlessly. That's crazy. That changes the whole equation. That changes the whole destination or where a company really should be. They should have savings. They shouldn't be broke. Companies shouldn't be living paycheck to paycheck. They shouldn't need uncollateralized loans to finance business operations. They should have fallback and safety and savings. And all these systems currently facilitate that. The needs of small business and enterprise. As time goes on, you're going to see uh, hopefully not uncollateralized lending, but you see under collateralized lending where it's not like 2 to 1, 1 to 1, 0.8, 0.7, and increased risk profiles and probably some sort of credit scoring system, an on-chain credit scoring system. And there you go. There's the capital inflow. There's the liability printing, and there's the transaction fees, and there's the revenue for us. And who's going to finance all of that liquidity? Because that liquidity requires a capacity to change denomination, and there's the opportunity for protocols to build systems and software and technology that does very interesting things, that has way too much friction in traditional finance to even remotely consider executing in any way resembling what has occurred in the crypto markets. Trevor's in the house, a pleasure. Dan, playing devil's advocate, do you see BTC becoming pristine collateral as well as similar to ETH one day? Well, collateral is collateral. Pristine collateral. Pristine collateral. Ethereum is pristine collateral. Ethereum denominated. That's why treasuries are pristine collateral, dollar denominated. Bitcoin is collateral because it cannot be used to collateralize. I guess it could be used in a centralized implementation or whatever the hell they're doing in Bitcoin land. But if you collateralize a Bitcoin loan, Bitcoin denominated, it's still not the case because you don't have duration. There is no real duration in crypto markets currently, and that's what pristine collateral ultimately means. If you have a 10-year bond, no matter what the market value is, you will get paid face value upon maturation. So that's what it means that it's pristine. You have an expected roadmap. You know where its value will be nominally at the end of the road. So this is interesting stuff. And how it plays out, there's a lot of mechanics, as you're saying, for things that are novel and beneficial to consumers. Why do you think bribes are lower for Aura than CVX? Well, Balancer is relatively small compared to Curve. So if you go over here, you could see that Curve's got 4.19 bill. Uniswap, it's about par with Uniswap right now with TVL. But then Balancer is much further down at a bill. So Balancer is 75% smaller. That's be interesting where it heads. But they certainly carved out a niche for themselves, and that's meaningful. But it's smaller. So what the significance of these systems will be in the coming years will be fascinating to watch play out. With the capacity to finance incentive systems indirectly, which is a form of like leveraged finance, but it's not leverage in the sense that there's a risk profile. It's just like amplified, magnified finance. So why pay people incentives when you could rent someone else's incentive system? And, it's hard. I'm sure protocols go through a fair amount of due diligence. We saw Stargate go back and forth between Convex and Aura, and I've even seen them at low level. The Curve, they were throwing around some capital, and they're probably doing their calculations to see which is the most effective. And it's going to be interesting over the next couple of years. We'll see. Another question: what do you expect total crypto curve market cap to be in 5-10 years? Well, I don't really think much about like market cap of assets. What I really hone in on is total stablecoin liquidity and composition, but mostly the market cap of stablecoins, because ultimately those are the currency units. Those are useful as money because you could spend a dollar liability. So if a dollar in a bank account, obviously there's a risk profile associated with a stablecoin as compared to a dollar in a bank account, as compared to a piece of paper dollar in your pocket. But the fact is, from a functional standpoint, they are identical. You could spend a dollar in a crypto stablecoin the same way you could spend a dollar in a bank account, the same way you could spend a piece of paper dollar. They're functionally equivalent. You cannot tell the difference. You could walk into a store and buy cup of noodle and ramen from the supermarket just the same. So that's very interesting. My primary consideration in assessing where we are from market conditions standpoint is total amount of stable coins. I tend to think of like market cap of assets as like an M2, like an inflated state, because you don't give a shit about the market cap of assets. If you sold every single asset, the total value that is extractable is literally the total amount of stable coins that are available. That is the maximum amount of money that can be extracted out of the entire market. So if you sold every single asset, obviously, let's assume a static market. If you sold every single asset of every single protocol, including Ethereum for that matter, you could only get $69 billion. That's it. That's all the currency units that are available. And obviously, it's a non-static reality, meaning you'll have bridging and capital flows and inflow, so that's a complication in the thought experiment. But all that matters is currency units. Listen, if you're not acquiring more currency units, you're missing the point. The whole point is this game is scored in currency units and predominantly dollars. And that's the whole point of the game. So you can get stable coins and walk into a supermarket and buy food for yourself and your family for the week. Another one, can you talk about issuing in-the-money call options as incentives as compared to simple token emissions. Yeah. Bottom line is that turns a capex into a capital raise of sorts. Uh, so I think that's one of the most innovative alterations to currency recycle regimes so far. So instead of emissions, it's options emissions. So every incentive that's handed out increases treasury because the incentive is there. The options are going to be bought because they're going to be exercised, and the profit's going to be extracted. So that's quite interesting. That means there's a constant inflow of capital just to capitalize on incentive emissions. Uh, it's going to take some years for that to solidify. Andre nailed it with fixed forex and tapioca subsequently, and then really third was pretty much Bunny. And then since Bunny, it's a complete avalanche of protocols that are swapping over to options emissions, and this is going to change total cash flow of protocols, inflow, balance sheet composition. Protocol and liquidity is going to be quite interesting in the next couple of years. I could go all day. Feel free to skip those. I'll try and chime in another stream. It's all good. What DeFi infrastructure is missing currently in your view? People are looking for new. Skip the new. Most of the innovation was done in 2020 and 2021. Curve nailed it with their concept of voter escrow tokenomics, and what V Matt talks about from Tapioca is spot on. He's got one of the greatest minds in the biz. And the innovation of the option emission that he saw with fixed forex, Andre's fixed forex, was a big deal. And what Balancer did, and then Aura, what they did on top, it was all based on V curve. That's it. Period. These are all variations, subtle improvements at the margins. But conceptually, these are currency recycling regimes, a capacity to build a federation of currency consumers, which in this metaphor is basically a currency sterilizer of sorts to absorb excess supply as to not incredibly distort circulating liquidity composition. So that's quite interesting. That this is the biggest thing. It's not just the biggest thing in the crypto markets. This is a tremendous thing from a traditional finance perspective. This has never been done before in private markets. To take what traditional finance does, what the U.S. has done since '71, and its capital account and its the trade deficit and its absolute need to export dollars and the need for other countries to sterilize their bond issuance to finance domestic fiscal spending. It's just wild, and we see all of this, but we see it constructed, iterated on in subtly yet interesting ways that you cannot do in traditional finance because it's just not technologically feasible. Too much friction. One curious view, my man, Hussey and IPOR to solve duration problem. You still like it? I like IPOR. The emissions is flawed. Or maybe not. Maybe it's just devastating to price. Which, can you tell the difference between flawed and just the price is just destroyed? I don't know. So technologically, sure, it's very interesting. I don't see a capital allocation as reasonable, either under current market conditions or under overall tokenomics design. I like the power tokens. I expect further depreciation. I expect further depreciation for all the markets, and that makes taking entries very difficult. Do you know what's going on with multi-chain? Yeah, an absolute shit show. I'm going to leave it at that. I have no idea, and I don't really want to speculate because that's a shit show. Very unfortunate. Unfortunate to see. How about selling options against assets to make them more productive? Yeah, derivatives, options. I'm not going to burn my brain on it. Of course, you could do anything you want in real time with instantaneous finality and permissionless access from a global perspective. It frickin' changes everything. Thanks a lot for the awesome answers. You're very welcome. It's a pleasure. Hey, Captain, what are your thoughts on Try Crypto NG? I started the stream, I think, with that. I think it is massive. I would love to see like SFXX ETH, EBTC from Badger, which isn't out yet, synthetic Bitcoin, and CRV USD. Wouldn't that be a ridiculous Try Crypto pool? So we're heading into very interesting times in the next couple of years with efficiency improvements that are going to change the collateral and liquidity composition of over $100 billion worth of markets. And that, come on, $100 billion, that's tremendous. We had nothing. There was nothing in 2019. There was less than $1 million on Uniswap. I remember the first $10 million transaction volume day on Curve, and it was like everyone was going crazy. It was like, what the hell is going on? It was less than that. It was $1 million, and everyone was freaking out, like, what's going on? Where's all this volume and activity coming from? It changed everything, and that was in 2019. It was nothing. It was nothing back then. I feel like Jim Cramer when he says, nothing. They know nothing. There was nothing. I don't even have a chart back then. It was zero. It was like pinned at the bottom. These lines didn't exist. None of this existed. BUSD didn't exist. DAI, it was Psi back then. None of this existed. Crazy to think about where we've come since late 2019. Aave was lend. Nobody even used it. And now there's billions of dollars worth of capital collateralized on Aave. And they haven't even released GHO yet to mainnet. That's going to be crazy. So all of this liability printing, it's all synergistic. You increase liquidity, you increase capital flow, you increase people looking for opportunity, you're increasing transaction fees, you're increasing interest expense on the liability printing. So you don't have to expose to all of it. All you have to do is be part of one of the systems. And you get to pick which one you think is going to perform the best, one that surfaces the best disintermediated cash flow. And all you got to do is let time do what it's going to do. It's going to be 2025, and there's nothing you could do about it. Except now you get to think about the choices, the options you have between now and 6 months, and whether you're going to get cheaper prices or not. Cheaper prices are great. And if you have assets, expect them to depreciate. Where do you think they're going to be in a couple of years? And guess what? Between now and then, they're printing money on a weekly basis. That's why Enterprise solves the short term, the midterm, and the long term. Other than savings, which solves fuck all. Saves. It's just the wrong thesis to save money. You save in the form of enterprise because you can live off enterprise. You can't live off savings because then it's gone. Hope that helps. Last two questions. I'm going to wrap it up for the day. Another question regarding Bunny. Do you LP? I do not. I'm a lockor. I lock for 4 years, and I get paid on the weekly. Hey, Cap, missed the first 15 mins, but have you talked your idea of going 2x long on ETH with SFXS ETH? I like that. I like that idea. I bought the ETH. I took my cash, and I got the ETH. I have a certain sentiment right now that I'm like, I don't need that cash, and it's going to be volatile, and I don't need it. So that's what I bought, and that's cool. The hardest thing is finding the comfort zone, and frankly, for all you folks that know me over the years, it's kind of strange for me to say that I'm actually comfortable, just like not even looking at it and just having it, and it's just there, and if I need to, I could put it in SFXS ETH and go over to Curve and borrow a couple grand, but I don't need to. But I can. So I have an option. So I have collateral I can borrow against to finance my CapEx requirements as a human enterprise. not an enterprise, just me as a human. Like if I need cash, I have collateral. So it's the same thing I've been describing with regard to small business, permissionlessly borrowing capital to finance my liquidity needs as a human enterprise. So that's cool. But plus, it's Wednesday. You know what today is? It's payday, and that's cool. So there's some more cash coming in. I'm going to keep it as cash. I'm not. This is not a market that I really want to be investing in, but I also have some collateral. I'm sentiment-wise, I'm comfortable with adjusting my balance sheet to have purchases, which are not collateral nor cash. They're just I own productive enterprise. I have obviously liquid currency units, dollar liabilities, stablecoins, and now I just added some relatively productive, useful collateral to the balance sheet to introduce optionality. That if I want to do something with it, I can. It's just changing the balance sheet composition. Hope that helps. Tapsy, human liquidity needs. Isn't that what debt is? When people are broke, they're illiquid. If someone's broke and they have a car or they have a house or even if they have a mortgage on the house, there's equity there. So it's just illiquid. It's an illiquid situation. So that changes in the crypto markets with permissionless access to credit. I can have collateral and asset, and if I needed liquidity, I have it in 5 seconds, and it goes on a debit card in 5 seconds. You can't do that with a house. It drives me nuts trying to express how significant permissionless collateralization and credit and liability printing is. It changes the whole equation. Thank you, everybody, for joining me today, Wednesday, May 31st at 1:53 p.m. These weeks go by, and I appreciate you guys listening to me tell these stories. I look forward to doing this for a long time to come. Tell everyone to subscribe. Can't help someone if they don't hear. You know the deal. After party on Discord for the most rational community in the entire crypto space. I will see you guys on Friday.